Good afternoon. Welcome to lecture 17, and the topic of this lecture is optimal taxation. The recommended readings, or specifically the prescribed readings, are Stiglitz and Rosengard, chapter 20. The topics that we'll cover in this lecture are two fallacies on optimal taxation, the optimal and Pareto efficient levels of taxation, differential taxation, and also taxation on producers. So we need to start with chapter 19, the previous lecture. So what did we cover in chapter 19? We introduced the concept of taxation and how taxes work. What we found that unless we use a lump sum tax, what happens is that there is a deadweight loss that is associated with a tax rate. So the question then becomes, if lump sum taxes do not result in a deadweight loss, then why do we not just impose lump sum taxes and not worry about a loss of efficiency? In other words, why do we not worry about then the deadweight loss by simply imposing a lump sum tax? Then if we were to impose distortionary taxes, is there some way they can be designed to minimize the deadweight loss? Specifically, if we impose some kind of tax rate, that is what results in a distortion. So how do we impose these taxes in such a way that we minimize the deadweight loss? That is what we cover in this lecture. And these are questions that have been central to theoretical research in taxation. And such research has produced some simple yet insightful answers, such answers that may help us to design better tax systems in the future by reducing or eliminating deadweight loss. There are two fallacies of optimal taxation. The one deals with a very simplified approach, specifically its simplicity is a limitation. And the other fallacy is that the world is so complex that nothing can really be said and done. So first of all, we start with the first fallacy, which says we should simply have a tax on wage income. And any additional taxes, let's say such as the value added tax, or specific taxes on goods such as alcohol or cigarettes, in other words, sin taxes, are just a contributor to the distortions and therefore distort economic efficiency. What we would rather do is one simple tax, one single tax, and that is a wage tax, both simple and a single tax. And we will have one distortion as a result of that, and not several distortions which arise with the imposition of numerous other taxes. This does make sense if there were no distortions associated with that type of tax, because then that type of tax would be the equivalent of a lump sum tax. The reality is there are other distortions associated with a tax. So first of all, as you recall, what would happen is that individuals' decisions to work are distorted. In other words, you might start working less beyond a certain level of income. So the labor supply curve is backward sloping or backward bending and not upward sloping. And the reason why is that because beyond a certain level of income, you are taxed so much that it makes no sense to work more. You'd rather consume more leisure. Additionally, the idea is that if you count distortions, you are simply thinking that each tax introduces a new distortion. Yet it is not necessarily the case that one large distortion is better than several smaller distortions. So in other words, having a single wage tax might not result in less of a distortion than having several smaller distortions. To demonstrate the recall from the previous lecture, what we showed is, using that formula, is that the deadweight loss from a tax is proportional to the square of the tax rate. Therefore, the larger the tax rate, the larger the deadweight loss. So it might make sense to have a number of small taxes as opposed to a single large tax, because the deadweight loss, the total deadweight loss arising from those small taxes might be lower than that arising from a single large tax. Next, what we have is a so-called theory of the second best, and this theory is concerned with the design of government policy in situations in which the economy is characterized by some important distortions that cannot be removed. This contrasts with this idea of first best economies where all conditions for Pareto efficiency can be satisfied. Now, the problem with the theory of second best is that it's often interpreted fallaciously as stating that as long as there are some distortions, economic theory has nothing to say. In other words, if there are distortions, we cannot do anything about them. This is not correct because economic theory tells us under what circumstances two small distortions are preferable to a large one. In other words, when is it better to have inefficiency in both consumption and production, and when is it better not to have efficiencies in production? So the message is that, unlike proposed by the theory of the second best, that we can't do anything about distortions, which is a fallacy, the message is that it's not easy to determine what distortions exist. But it is not impossible. It is also not impossible to determine, once it has been determined that distortions exist, as to what to do about these distortions. Now we need to extend the concept of Pareto efficiency a little bit further. Recall in chapter 3 that we discussed this idea that a resource allocation is Pareto efficient when no one can be made better off without someone else being made worse off. The reason that I'm restating is because we go to extend this concept a little bit further. We can also have a Pareto efficient tax structure. So what is a Pareto efficient tax structure? It is one that exists such that no alternative tax structure can make some individuals better off without making other individuals worse off. In other words, if there are alternative tax systems that exist that can make individuals better off, then the current tax system that is being instituted and applied is not Pareto efficient. It is clearly inefficient. So therefore, there may be a number of Pareto efficient tax structures, just as there are many Pareto efficient resource allocations without taxes. Now, how did we choose amongst Pareto efficient allocations? Well, what we looked at is we looked at the social welfare function. And these social welfare functions can also be used to choose among Pareto efficient tax structures. So the idea, as with resource allocation, is to choose a set of tax or a tax structure that will maximize the social welfare function. And what that will yield is, or what that will result is, in an optimal tax system. Let us begin with our base case. The base case is our Pareto efficient tax, and that is a lump sum tax. So all individuals, regardless of how much they earn, pay the same amount. Now, the problem is that any other tax would introduce distortion. So it seems that we should essentially go with a lump sum tax. Now, a lump sum tax requires that everyone is the same, that they earn as much in order to be able to pay and bear those taxes. And if everyone is the same, then there is no reason to redistribute income. However, the reality is a little bit more complicated. Individuals differ, and governments wish to redistribute income. And this requires that those who are able to pay taxes more easily should pay more taxes than those who cannot pay taxes. This is something that a lump sum tax does not do, because it requires the rich and the poor to pay exactly the same amount. If lump sum taxes are non-distortionary, why is it that we go on to impose distortionary taxes nevertheless? Well, the reason why is that because government can only tax observed variables such as income and expenditure. So government can choose to impose a uniform lump sum tax regardless of income. In other words, everyone pays an equal amount regardless of what their abilities are, but not everyone is equal. So from that perspective, this is not a fair tax. Some people are not working, so they shouldn't be paying tax. And others are working, earning little, and paying a lump sum tax will impact them. And some are earning a lot, and a lump sum tax doesn't really impact them. So what governments choose to do is they choose to impose taxes on easily measured variables. So what is it that we can measure? Well, we can measure expenditure, how much something costs. That's why you get value-added tax. So that is one type of tax we could impose as an example, or alternative income. So everyone earns something and that is easy to be measured. But the drawback is that imposing such taxes on measurable variables is distortionary. So a distortion nevertheless arises. These taxes are not perfect either, aside from the distortionary aspect. So for example, an income tax may not always succeed in taxing those who we think ought to be taxed. It treats equally an individual who has low ability but works extremely hard and the individual who has high ability and takes it easy, provided that the two individuals have the same level of income. So two people might be earning as much, except one is working a lot, one is working hard in order to earn that income, and another is not because of ability. Yet they still have to pay the same amount if we impose an income tax. So one could argue this is not exactly fair. Nevertheless, the belief is still that those who have a high ability to pay, in other words, a higher income, ought to pay a higher share of government costs. So they should contribute more to the fiscus. Furthermore, there is also another consideration. In other words, society may value the loss of income by the rich less than it values the loss of income to lower income individuals. Specifically, if someone is earning a lot, they suffer less from being taxed than those that are earning very little and are still being taxed. So this is what that statement implies. So the reason why we use distortionary taxes is because of our desire to redistribute income in a world in which the government can observe the characteristics of individuals only imperfectly. Nevertheless, some tax systems are less distortionary than others. This brings us to the question of how is it that we design an income tax system? And in order to investigate this question, what we need to do is we need to make a few assumptions. So first of all, we assume that individuals do not have any savings and that the only income that they have comes from what they work. In other words, it is the form of wages. And the only type of tax is an income tax. And the question this leads us to, how progressive should a tax system be? There is a trade-off that we have to accept, so that the more progressive a tax system, the larger is the deadweight loss and the larger the inefficiencies from the tax. However, the more progressive it is, the less of a degree of inequality arises. Recall that the idea of progressive tax is that those who can pay more do pay more in terms of taxes. So that is what a progressive tax system is. Now, if we use our tax system to attain greater equality, the deadweight loss increases. Why? Because with increasing equality comes a greater level of progressiveness in terms of the tax system. So how we can quantify the increase in the deadweight loss is as follows, using the marginal tax rate, which is simply the ratio of the change in the tax rate relative to the change in the income. So it is related to the deadweight loss, that is related to the substitution effect, and the magnitude of the substitution effect is related to the marginal tax rate. So more progressive taxes have higher marginal tax rate and thus a greater deadweight loss. That is the idea of progressive taxes, that as you earn more, you pay more. So hence the marginal tax rate rises by more in a more progressive tax, or is greater in a progressive tax system, as those are in an additional income bracket or higher income bracket pay more in terms of taxes. So for example, those earning let's say £1,000 will pay 10%, but those earning £2,000 will be charged an additional 10%, in total 20% on the next £1,000, from £1,001 to £2,000. So that is where the marginal tax rate comes in. And hence, the greater these marginal tax rates, the greater the deadweight loss. Now, the government uses different types of taxes, and we can call these so-called differential taxes, which means that taxes are imposed at different rates on different commodities. So for example, the taxes are imposed on your fuel are different than the taxes that are imposed, for example, on normal purchases of food, which would be the value added tax that would apply. So these rates would be different, and this is an example of two types of taxes. But of course, there is a multitude of taxes that is imposed. So for example, what we would have is something called benefit taxes, and these would be applied when we are buying airline tickets, so they would be reflected in airline tickets. So why would such a tax be imposed? Well, somebody has to pay for air traffic control. So when you buy a ticket, which includes a benefit tax, so you pay a portion of that price in terms of taxes, that goes to fund the air control and also to fund potentially the airport, and other aspects are related to your flight which are not directly associated with the airline itself. Other taxes are such as taxes on gasoline, so for example, or gas, specifically petrol. These are taxes that we can see as being corrective taxes to ameliorate some of the negative externalities that they generate. In other words, to deal and address some of the negative externalities, such as pollution, that they generate, and such as traffic congestion that is associated with driving. There are also luxury taxes, so you have taxes on luxury goods such as perfume, such as luxury cars, and the idea here is to increase the redistributive nature of our tax system. So the thinking here is that if you have money to buy luxuries, you should part with some of your money in order to fund equality. Other types of taxes, there's also something called the sin tax. So these are taxes that are charged on cigarettes and beer, and they could potentially be used to fund the healthcare system. Of course, drinking alcohol and smoking in excessive amounts can be associated with ill health. You are treated at a hospital. So hence, that's why a sin tax might be opposed to fund these services. And also to, again, correct externalities, and also to discourage you from smoking. So now that leads us to an additional two questions that we try to answer. First of all, if the government cannot impose an income tax to redistribute income, what rates should impose on different commodities? And second of all, if the government can impose an income tax on redistributable income, should it also impose on taxes on different commodities at different rates? So this leads us to something called Ramsey taxes, and the proposition here is that they are commodity taxes that minimize the deadweight loss. And these taxes are such that they are proportional to the sum of the reciprocals of the elasticities of demand and supply. Recall what was the elasticity of demand and supply? It was the change in quantity with respect to the change in the price level. So this is the elasticity of demand, this is the elasticity of supply. And how we define the so-called Ramsey taxes as the ratio of the tax per unit to the price that is received after a tax. So this is this ratio here. And this is proportional, in other words, directly related to the total amount of revenue that a government is attempting to raise. But it is inversely related to the elasticity of the compensated demand curve and also the elasticity of supply. So these two terms here, the sum of these two terms. So note the K is now in the numerator, and these elasticities will be reflected in a denominator, assuming that we are using values instead of notation. What Ramsey showed is that in the absence of an income tax, different commodities should be taxed at different rates only on the elasticities of demand and supply. However, the reality is in all industrialized nations now, what we view or what we see is progressive income taxes. So the issue is a little bit different. What we need to worry about is an optimally designed tax, and such a tax ensures that the marginal benefit of the extra redistribution that comes with that income tax exceeds taxes on commodities, let's say a tax on luxuries, where the marginal cost is measured by an excess deadweight. So it goes on to state or be argued that differential commodity taxation is undesirable, and that if an income tax is well designed, adding differential commodity taxation is likely to increase the ability to redistribute income little, if at all. Therefore, it makes no sense from this perspective, on the basis of this statement, to tax commodities at a different rate. Specifically, what we should do only is then tax income. So that leads us to a specific argument, and that argument is that if the objective of taxation is to redistribute income, what then should happen is that we should tax income, and the focus of taxation should be what we are therefore really interested in. Specifically, that is income. So we redistribute from those that are able to pay to those that are less able to pay taxes. What about taxing producers and not just taxing income? So does Pareto efficient taxation imply that taxes should be imposed on production processes and not only income? That's the question we investigate next. So in chapter 3, what we suggested is that imposing taxes on production impacts production efficiency. In other words, the economy is no longer able to produce on its production possibilities schedule. There is an inward rotation on the top and bottom of our production possibilities curve. So if you recall, this is the production possibilities curve, assuming that we have good A here and good B. And what happens is if we introduce a distortion, we have an inward rotation of these elements from here to here, from here to here, inwards, that is. So that is the result of a distortion. Now, let's assume that we have a perfectly competitive economy, and in such an economy, all firms face the same prices. So all firms will set the marginal rate of technical substitution equal to the same price ratio because all firms are facing the same price ratio. So hence, all will have the marginal rate of technical substitution. Remember, there's many firms in the economy and they're identical, and that is why we can make this assumption. And that is an assumption that occurs under that of perfect competition. Thus, if we tax firms differently, so we deviate from this idea that we are applying one single tax. If a tax on inputs is not uniform across all firms, what this will result in is an economy not being productively efficient. So for example, let's say one of our inputs is gasoline, and all firms use gasoline. And two types of businesses that exist in our perfectly competitive economy are businesses and also farming, and both of them use gasoline, in other words, petrol. So let's say that we now tax this input, the same input, for businesses, but not for farming. So therefore, there is a non-uniform tax that is charged on petrol. So for businesses pay a tax on petrol, whereas farmers do not pay a tax on petrol. What is the result of that? The result is a deviation from productive efficiency. So let's say we now impose a tax on intermediate goods. And what we will arrive at, or the conclusion we will see, is that a tax on intermediate goods is distortionary. Think about it this way. Where does the distortion arise? We need to make a few assumptions. So let's say we have a firm that produces computers. And in a competitive economy, what we'll do is we'll sell those computers at the cost, cost of production, which is the cost of the factors that go into producing that computer or using the production of that computer. Now that computer can be sold to other firms at cost who would use that computer in their production process. Now let's say we introduce a sales tax. What happens then? The sales tax is then reflected in the cost of producing that computer. In other words, there's the cost of producing that computer plus the tax. So anyone that purchases that computer now and uses that in their production process has a higher cost that they have to pay than that computer was originally manufactured at because of that tax. So what happens? Whoever is using that computer in their production process and purchased it subject to a tax now has higher costs of production that reflect that tax. So whatever they are using that computer to produce is no longer the sum of the cost of its factors. And hence, what we have is a distortion. So the question is this: should the government impose such distortionary taxes if it wishes to minimize the deadweight loss of the tax system? Well, the answer is that the government should impose no distortionary taxes on business. Whatever the government could do with a distortionary tax on producers, it can do better with a direct tax on consumers that maintains the economy on the production possibility schedule. So the argument when it comes to taxing producers is that no, we should not tax producers. Instead, if we want to minimize a deadweight loss and achieve redistribution and hence contribute to efficiency, we should instead tax consumers. And the result is that we can stay on the production possibility schedule.